Ahoy there. If you're looking to swing trade the markets, then you're in the right place. I'm going to be breaking down, as usual, my number one strategy, which is a part of the process. Oops, wrong one. Part of the process that I call production line trading. It's a simple rule-based system. It's proven, profitable, repeatable. It takes 20 to 30 minutes a day, a few times a week when you get used to it. And obviously, when you're learning something new, it might take you a little bit longer, but when you get it and condense it down, it will take just 20 to 30 minutes. The reason why I do this is I teach what is essentially a classic interpretation of trend trading with a modern twist. And most people get it wrong. Most people talk about buying the dip, and it doesn't actually mean what people think it means. I'm going to show you how to find a buyable dip in an uptrend. And it's that last part that is the qualifier. Just because a stock is moving down doesn't mean it's a buyable dip. It is just dipping essentially. But if there's no uptrend, there is no dip to buy. So I'm going to show you what a dip worth buying actually looks like. So if you are new, today's agenda is we're going to spend about 60 minutes together. My cat's going crazy. Just goes to show it's live. Dude, what's up? Someone's freaking him out. Oh, come on, man. Sit on my lap while we trade. Oh, animals, who needs them? Right, we're going to spend about 60 minutes together. Going to have 2 minutes for the intro, just to introduce myself to those people who are new. As you probably gathered, my cat is joining me today because something's freaking him out. Hello. We're going to look at the stock market. We're going to look at production line trading, and then we're going to review the top 25 stocks. Commercial intent warning, as always, you are invited to work with me. This is the hardest pitch you'll ever get, and that's it. I'm a trader first, I'm an educator second. I enjoy doing the second thing, but I don't have to do it, unlike the majority of people in this industry. So if you want it, it's there. If you don't, that's cool. I try and give as much away as possible in these Friday open sessions so that you can go and do it. And the way you get most value out of this session today is like, comment, interact, ask questions. I've got the chat box on my other monitor. Hello, and bonjour, Anthony. Usual welcome. And if you're watching this on the replay, if you've got a question, pop it below and I'll get to it when I see it. As usual, quick warning, there will be no diamond hands. No one is going to the moon. We are following rules. Simple, effective rules. I'll demonstrate them to you in a moment, which work. First and foremost, it prevents me from sitting at the charts like a mindless zombie. We've all done it, and I never want to do it again. It's a waste of time. It's a waste of effort. It's a waste of resources. No one ever wants the experience of flicking through chart after chart, hoping that we find something worth trading. Best way of thinking about this, it's the difference between where's the trade and there's the trade. If you ever find yourself asking where's the trade, you're doing it wrong. Something is not right. You may have all the knowledge and the tools and certainly a skill set, but if you continually ask yourself where's the trade and you're spending hours under the guise of I'm doing the bunny fingers behind the scenes here, analyzing the chart, then something's going wrong. What we want to be able to do as traders with a proven, profitable, methodical, rule-based system is go, there's the trade right there. And that makes it time efficient. And how we get there is by using rules. And it's not sexy. It's not fancy. It's not like you see on the TV. We're not playing Wolf of Wall Street. It's boring. When you get right down to it, any process that's profitable and proven is boring. It is like a production line. I refer to what I do as production line trading, but I think I would rather be bored and make money than be excited and lose money. And you've only got to go to Wall Street Bets and look at all the lost porn threads to see all the excitement of people gambling and buying lottery tickets because they don't know what they're doing. So follow a simple process. I'm going to show you one of mine in a moment, but just to demonstrate it works. Again, I've get my own results. My results are not really that important. It's just really to demonstrate that it worked regularly, consistently. There are losses. I do have losses. I talk about the losses, but it uses a data-driven strategy to find and execute opportunities. And here's some losses on the screen. We've got a lovely trend. This is the S&P over the last 12 or so months. All the blue circles, they're the profitable parts of the process. All the red circles, they're the non-profitable parts of the process. It is an algorithm. I'm going to show this to you later anyway, but what I'm looking for is a positive expectancy. We can also profit from the downward movements in the stock prices. This is the S&P. It's the same instrument, just the ETF version instead of the futures. We can also sell the rally in a downtrend. So we need to find a sellable rally in a downtrend. And we've been speaking about it for most of this year, that there was a transition in place. Then when it happens just a few weeks ago, we spoke about it, followed it, monitored it in real time, and we executed that trade here on these open sessions. So there are going to be times, again, just to be open and transparent, where it doesn't work. We do lose some money, but it's not broken and I don't need to fix it. I just know that on average, I'm going to make money. So one trade doesn't make a good strategy or a bad strategy. It's the long-term multiple occurrences that makes it a strategy. And I want to apply that strategy with consistency. And again, coming back to the whole point is rules allow me that consistency. I need to keep myself on a tight leash. And again, I want this for me first. This is where the nucleus of all this started. Like, I was like everyone else. You have this emotional roller coaster of, where's the trade, as I described earlier. And when you start to define what you're doing more precisely, you develop very specific rules. And what I'm looking for is that if this, then that, then take action experience. And that's what we've boiled down to. It took 28 years to get here. And you don't have to spend 28 years trying to figure it out. You can quite literally plug into my, the 10,000 hour thing. You don't have to go through the gauntlet for yourself. So who am I? I'm just this weird guy behind the computer. I'm a regular guy. I'm not a Wall Street guru. I've just found my success. I do these open sessions to give back as much as possible in the limited time that we do have together. I like cake, coffee, walks, and strangely flamingos. We've all got a thing. Flamingos is mine. Don't mock me for it. We've all got something weird, and that one is mine. Nonetheless, I've been trained since the 90s, started hand-drawing charts in the mid-90s rather. The last 20 years, I've been helping good people become world-class traders. And as I just mentioned, I am not a Wall Street guru. You should most definitely not listen to me. You should never consider anything I say as financial advice. We're all responsible adults. It's your money. You need to take care of it. However, I can show you that the process that we use is repeatable, it's replicatable, the data shows it, but legally, obviously, we have to say that the past performance is no guarantee of future performance. Again, we're all responsible adults. We know how it rolls here. It's, the law's there to protect you as well as me, but nonetheless, what we do works. You don't have to take my word for it, as always. I've helped thousands of traders become good traders, and by plugging into this tried and tested system, again, everyone that I work with gets some measure of their own success. Will you get exactly the same success that I get? No, you won't. You will get your measure of your success based on where you're at, and there's a few variables that go into it, but you should see some measure of success. Help you plug into a system which I keep calling production line trading. As I mentioned, it's a rule-based system that allows me a lot of time freedom. Like, I'm a big fan of, we should not be spending hours doing this. And it's this rule-based approach that means that I can just check in, check for trades, and check out. So I'm going to show you my number one money-making pattern today. It's one of 6, and it is part of a larger system that I refer to as production line trading. And we're just focusing on a very small part of the mechanical trading approach that is part of the production line trading. And again, if you want to work more closely with me, you can. I have a group environment which is excellent, helping many traders navigate the murky waters of the markets, as well as obviously help them get their measure of success with the same system that we approach and use. And I do have some availability for one-on-one mentorship, although I am paring down from doing that on a regular basis in the future, just because I value my free time more at the moment. Anyway, that's all said and done. Let's move away from the slides. Let's go and plug into the charts. I know, Kit. So we're looking at the markets. As always, I want to try and figure out, is there anything weird going on? One of the first places I often start is over here on the left. And I'm typically looking at the percentages right there. And all I want to know is before the market opens, and keep in mind, I'm a few hours ahead of most people in the US, just because I'm based in the UK at the moment. And I'm looking to see if there's anything weird that's happened in the Asian markets, in the European markets, that might give us a clue of, is there anything funky going on that might impact the US markets. And the way that the Globex futures work is they're effectively 24 hours a day. They're not quite, but they're effectively 24 hours a day. So we kind of have this real-time snapshot of there's either something going on or not something going on. 99.9% of the time, there is usually nothing to worry about when it comes to the markets. There's no flash crashes on the horizon, but that is essentially what I'm looking for. Is anything weird going on? Okay, no, I probably don't need to worry about the markets today, at least in the short term. There's a range of movements at the moment, plus or minus about 1 percentage point seems to be the normal range of movements. And we can see that right now we're in that normal range of movements, despite the big percentage numbers, the headline numbers that you'll see on all the news and the talking heads. It's, as a percentage, it's a normal range of movement at the moment. As we know, the bear market chatter is on the lips of everyone at the moment, the talking heads. I've got to admit, I'm not really that concerned. I play both sides of the market. So if the market crashes, I'll get paid faster. That's what happened in 2020. If the market goes up, I'll get paid. If the market goes down, I'll get paid. Sometimes when the market goes up or down, I'll get paid in the up and down swings, which is what we're trying to do. I take a portfolio-based approach that will benefit from any direction. So big question on most people's minds right now is, is this the bottom? Everyone tries to pick a bottom. That sounds rude, but you know what I mean? Oh, I've got a little bit of a, let me just have a quick drink. A little bit of a tickly throat. So is the bottom in? Everyone's trying to pick bottoms, no matter how crude and rude that does sound, but that is what people want to know. I think when you're trend trading, you don't need to worry about the tops and the bottoms. You just need to profit from the bit in the middle. And we can very quickly illustrate that. If I was to try and I've got to admit, I didn't. I got my ass handed to me right there. I got caught the drop. And then had my ass handed to me on the V-shaped recovery, because like most people, I was expecting a retest below a double bottom, if you like, before we saw the rally. Anyway, despite that, if we just look at the average prices crossing over, to be fair, it was that prompted me to firm up my own rules, take my own advice, practice what I preach, and go and, you know what? Is it me? Is it the markets? Or is it the strategy? And it was a little bit of all three, as it turned out. A little bit of complacency, trade my own opinion. And I thought, you know what? I can firm up my own rules. So around about here, that's exactly what I did. I was firming up my own rules, just to try and make sure that I can eliminate discretion from my trading. And I think I've succeeded in that right now. So I'm very pleased that it only took 28 years to get there. But I try not to have any views of the markets. So it was about here that we transitioned from using some discretion into what is essentially now a completely mechanical trading strategy. But if we just look at the average prices, we're looking to buy dips. Again, we're never going to get the bottom. You're never going to get the top. But I think if we can all get that bit in the middle, I think everyone's going to be happy. This is why I trend trade. Trends typically last for long periods of time. So I don't need to stress over the bottom. I don't need to stress over the top. And what we could be looking at is a new trend. But nonetheless, everyone keeps asking, is the bottom in? Oh, there's no way of saying that without having it as a double entendre, is there? So let's explore bottoms for a moment. Oh dear, it gets worse, doesn't it? It's my childlike mindset. I can't help but titter over it. I am a schoolboy at heart. So what we're looking for when it comes to trying to pick turning points, I'll say turning points in the markets. When we're trying to pick turning points in the markets, I can't even say that now with a straight face. What we're looking for is a repeatable footprint. So rather than just guess over, like, is this the bottom? Is it a turning point? Are we going to see the market rally? Are we going to narrowly escape a bear market, a recession, et cetera, all that nonsense that you see, and to be fair, bullshit that's in the media? Let's go and look for some clues. So what I'm going to do is I'm just going to press the back button, and I'm going to go all the way back in time. Because the wonderful thing about charts is we've got all the data that we can handle. So I'm now looking back at the early noughties. So this is true. You might recall we had the dot-com crash, which led into a bear market. And what you'll start to see when you go back through bull and bear cycles, and I've experienced many bull and bear cycles since the mid-90s, even before I officially started trading, I was an observer of the markets, even if I wasn't a participant. I was quite, I don't know, weird as a child, fortunate as a child. I was quite lucky that I got into this very, very young in my early to mid-teens. Nonetheless, what you'll see is that's middle line here. That's the 200 period moving average. General rule of thumb is over it, bullish, under it, bearish. And if you stick to that, you won't go far wrong. So just keep yourself, on the right side of the movements. And again, don't worry about the average. Don't worry about the average prices crossing over. That is a part of my overall system. But if you just generally keep in mind the 200 period moving average, are we over it? Are we under it? Okay, we'll below it. We're probably going to be biased to the bearish side. If we're above it, we're going to be biased to the bullish side. And again, I've tried some variation of that for all my trading career, and it just works. So we don't have to use the tools that we have in the traditional sense. We can just go and look at using these tools. And again, the moving averages are what's on the chart here. We can use them as a frame of reference. So I've just wound the hands of time forward. Again, there's 2000, there's 2001. There was no Space Odyssey involved. There's 2002, just so that we've got the context for, we're looking at about 2 years of time history. So what I'm looking for is, again, clues. There's one of those double bottoms there. So just because we have a double bottom or even a multiple bottom, it doesn't necessarily mean that the end of the move is over. And conversely, we can arguably see some V-shaped pattern there. But when we scroll through the hands of time, what you'll notice is there's usually, oh, there we go. It wasn't over. And there was no V-shaped recovery. If it stays below the 200 period moving average for a long period of time. So this is usually how a bear market, a bear movement, and this is not necessarily odds, but it did last for multiple years. And again, we get that wide V-shaped pattern. Now compare that to this one here where it's teeny tiny. This is normally what you'll see. There's a wide distance in time, only a couple of months between those double bottoms. That's usually the first footprint that we can look at to help us determine if there is a turning point in the market. So those small ones, they can act as turning points, as we can see there, but does it mean that I'll say it one more time, it doesn't mean that the bottom is in. What usually happens afterwards is some form of consolidation. A basing is what you may have seen or heard if you've read anything about it. So we can see the markets meander sideways. Now, although this is a bear market, can't go sneeze. Although we've got a bear market, we've got a consolidation here. If we were to flip this over and invert it, this could arguably be what we've just seen through 2021, couldn't remember what year it was then, into 2022, because for most of this year, 2022, we've seen a consolidation. Does everyone recognize this as a footprint? Long trend, again, we're just looking at the opposites. Long trend, basing price action, direction change, and there we go over the 200 period moving average. Let me pause there for dramatic effect. Is everyone spotting the same footprints that I'm spotting? Pop a little comment in the chat box. A little yes, a little oodaloo. I've got it. Perfect, Randall. Thank you very much. Awesome, Perry. Thank you. So what we've just discovered through observation alone is that we've just seen the very same but inverted pattern on the markets. Again, I'm trying not to label anything as head and shoulders. I'm just trying to recognize trend range, and in reference to the 200 period moving average. That's all I'm trying to do. Where is price in relation to that moving average? It's either trending and moving down, making a series of lower highs, lower lows, and then it's meandering sideways, and then it's transitioning. You get trend base, expansion, contraction, trending, ranging. That's all I'm really interested in. As to what the names of the patterns are, you can read the Dow through the Gann through the Elliott wave theory. You can read the triangles, the wedges, the double tops, the head and shoulders, the blah, 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 and all the other bullshit that's very, very subjective. Who cares what it's called? let's just recognize the phase that the price movement is experiencing. If it starts at the top left, finishes at the bottom right, it's in a downtrend. If it's kind of meandering sideways for a period of months, it's going sideways for a period of months. Let's just recognize the phase and the clues that that could then offer us. And again, as we've just established, it then goes back above the 200. So we've just seen that happen. So there's our first footprints that we can observe. Now, if I just go back to present day, there's exactly the same pattern. We get the trend, we get the not quite sideways markets, but it wasn't really going up anymore. It never went up from the beginning of 2022. Same sort of size, about 3 to 6 months is what we saw previously. We've got 3 to 6 months here. Then price goes below the 200. So you've got to ask yourself, is this the bottom? Again, we've got a tiny, we observed it previously, we've got a tiny little V-shaped pattern there, a double bottom for a better description. And we've observed that that when the bottom is in, they're usually quite wide over, 3 to 6 months is what we've noted. So these turning points, they don't happen quickly, is what we need to observe. This, and I've got to admit, I've got to point out the elephants in the room. That is the exception to the rule. That the COVID crash and subsequent recovery, that is the exception to the rule. If you go back, if you become a study of the markets and look back, not just over the last 20, but go back 50, 100, 200 years, the data is out there. And look at all the corrective moves, the crashes, the corrections, you'll see that that is the exception to the rule. But what normally happens is turns in the markets are usually slow. I sometimes compare this to, it's like trying to turn an ocean liner around in a canal. And if you all remember the Suez Canal instance, you'll know that it's not quite possible to turn an ocean liner around in a canal without it getting stuck for a period of time. So absolutely, Perry. I mean, Perry, you know the story more than anyone. You can start to see why I was doing it. So what we do have is, so we go to 2003, coming back to our timestamp. I'm just going to press the fast forward button. We're looking at 2005 now. So although, where's my little drawing widget? There we go. So although price is, I remember trading this. This was an absolute bugger to trade. But for a period of, many, many months, the markets can meander sideways. So it's those V-shaped patterns. Again, I don't care what they're called. Arguably someone is going, it's a head and shoulders fill. Oh, it's a double bottom. I don't care what it's called. It's ranging over a period of 3 to 6 months. That's what you need to observe. Ranging over a period of 3 to 6 months. Going sideways for a period of 3 to 6 months. That's all you need to observe. How do you tell if it's going sideways? Look at the 20 period in relation to the 50 period moving average, and you will see multiple average price crossovers. Let me just put those numbers on there, 20 and 50 period moving average. They're flipping and a flopping. If you see more than 3 in a row in a very short space of time, it's really difficult not to say, you know what, this is ranging. It is a statement of fact at that point. It's undeniable that now you know the secret to, is it ranging or is it trending? And it is the 20 crossing and flipping and flopping above and below the 50 period moving average more than 3 times in a row in a very short space of time. It's probably not trending, and it probably is ranging. It suddenly becomes a statement. We start to say those statements, there's the consolidation. Again, don't worry about the name of these things. If you want to try and label it something, do it afterwards. Again, when I gave up on trying to label things, and I was a pattern trader for the first 12 years of my career. I was very, very good at it. I decided to count up all the patterns that I knew one day, and I got to 34 different names patterns, and they're all very similar with slightly different rules. And I gave up on trying to label them. I just thought, well, why don't we just call it what it is? It's a contraction in price, and who cares what it's called? Just recognize mechanically whether price is trending or ranging. So we've got that. So when you've got that, you can see the waves over a multi-month period. And when you've got that in place, and again, price is above the 200, there's no bearish sentiments on this part of the chart. So everything that you are looking at, is essentially staying bullish. And then we come to 2008. We have the price, the last major, we were in a bear market before the crash happens. Just remember that. 2008, we were in a bear market before the crash happens. How do you know that, Phil? Well, the average price went below the 200, the 50, and the 200 period moving average crossed down, and pretty much stayed below all the way up to when the eventual and subsequent crash happens. So this is the 2008, there it is, the 2008 crash. And in contrast, the actual crash part of the move wasn't as big on the stock market as other instruments. Don't get me wrong, it was painful for a lot of people, but there was no surprise that it was happening. So basing, consolidating, we're seeing price meander sideways for a long period of time. We have to do it visually, mechanically. We've got 1, 2, almost 3 crosses there. Again, not quite at the same level, but it's hard to say that price is still trending at that point. Again, we know then what we see is price goes back above the 200. So we've got another footprint. Consolidation, again, before this, sorry, I should have done the bullish side. My apologies. The bullish side is the same. You've got multiple crosses in the average price. Consolidation, 3 to 6 months. Then that transition past the 200 happens. Consolidation for 3 to 6 months. Then that transition happens. Can everyone see the footprints? Consolidation, then transition to the other side of our 200. Consolidation, transition, consolidation, transition. That's what we should be noting. Consolidation, transition. So let me go back again. So So what have we got? 2010. This was a little bit of a, I think 2010, again, if you were studying history, there was a flash, well, there is, you visually can see a flash crash. Is this the time? I'm trying to remember. Has anyone read the book Flash Boys or Flash Boy? And I think it was, there was some market manipulation going on. A couple of programmer types had identified a snafu in the algorithms or the market's pricing. I think it was 2010, and this was the reason for the flash crash. What we can see, price pretty much having an adverse reaction. Guess what we've got? Consolidation. So we didn't see a bear market transition, but we did see price flirt with that, the possibility. But guess what? For 3 to 6 months before the next move happens. So what we're observing is it doesn't always mean a transition to a bear market, but it does always mean that there could be a transition to a trending movement. So that 3 to 6 month transition period, what would you say? Is this looking like an important observation, a recognizable footprint that we can observe very easily? Multiple crosses in our 20 and 50 period cross. We've got to call that section a consolidation. It needs to last for 3 to 6 months. We've spotted it several times now before the next movement. And if it stays above the 200, it's a bullish movement. If it goes below the 200, then we're looking for a bearish transition. But that footprint's looking pretty interesting. Let me press pause there. Is everyone seeing what I'm seeing? Can you see what I see? The coffee's just kicked in if you've not gathered. I'm talking a little bit hyper fast today. But it's an easy observation to make. And what you all should be able to do from now onwards is to say, is the bottom in? Is this the bottom? You know what? Probably not. We've got, again, we'll do it in a moment. Well, if we skipped back to the time, we've got a V-shaped pattern, a double bottom, if you want to put a label on it for a moment. It's over, it's 1 to 2 weeks is how it's lasting. It's not looking like that. Now, we can see turns. We saw that on the COVID crash, where we see a V-shaped recovery. It's the exception. Doing my Sean Connery impression now. It's the exception to the rule, but it does happen. What's more common is that 3 to 6 month consolidation. Now, this is how I generally start off any analysis. It just starts with observation. Scroll through. All right, now with the benefit of hindsight, we've got some empirical data. If I wanted to do something with this observation in the future, I could. Yeah, I could do something with it. Thanks. The markets are officially open. I think Brett's just saying ding, ding, ding. We're open. Completely derailed myself there. So consolidation, 3 to 6 months. Where is it in relation to the moving average? Is it above it? Is it below it? And that's usually going to be a good indication for the next movements. So again, off the left of the chart there, there's that 3 to 6 month consolidation. Again, trends last for long periods of time. And I appreciate this was Fed-induced printing presses at the ready. 2015, we're up to now, 2015, 2016. If anyone remembers this, this was a bugger to trade. Visually, we can all see that, but let's just go mechanically. I'm just circling the crosses in the average price, the 50 and the 20. The 20 flipping and flopping over the 50. When you have multiple instances together, you've got to call it a consolidation. So what we have this time is we have an angled consolidation here. You know, call it a rising channel, just so if it helps you visualize the label. I don't really care these days. But if you want to, we've got to call it, because we have multiple crosses in the average price. So it is pointing upwards. So you're going to have from time to time this weird situation where the market's doing two things at the same time. It's going up and it's consolidating. Well, that's a bit of a bugger. Recognize the phase of movements. Prices in a contraction phase. When you see the 20 and the 50 flipping and a flopping, you've got to call it a consolidation. It can also be pointed upwards at the same time. So is the fact that the market was slowing down and then transitions, again, we know that there were some big sell-offs, that then transitions into what turned out to be a whole year of sideways. Is it any surprise that it was coming? Again, what happened? I appreciate we're looking at with the benefit of hindsight, but is there any surprise that it was coming? We've got multiple crosses in the average price, and then we've got multiple crosses in the 50 over the 200. So we've got to call that area, after three of them, after that point, you've got to call it a consolidation. It's straddled over the 200. So let's just wait for a move above. Let's wait for a move below, and then we can start calling it a bull or a bear market. Again, we're looking at it with hindsight. We do know what happened next, but you can see the footprints. Now you know the secrets. It leads into a trend that lasts for many, many months, sometimes even years. We're now up to 2018. Am I pointing out the obvious, folks, now? Do I need to go on any further? You tell me. But is this driven the point home? Has this driven the point home? You'll get it. You'll see it. Should we move on? Should we go look at some trades? Now you know the secrets. Let's move on. Multiple crosses in the 50 and the 20. Prices below the 200. You've got to call that section of chart at least a consolidation. Is the bottom in? You tell me. For the moment, prices below the 200. I've got to continue to call this a downtrend, and I've got to look to sell the rallies in a downtrend. We've already seen that trends back in 2000 to 2002, and then just in 2004 before the big bull move, they can last for 12, 15, 18 months, up to 2 years. They can last for long periods of time. They don't often last for a long time, in fairness, but they can last for many, many years. And if you go back to the early part of the 20th century, in the middle part, you know, the bear markets have lasted for many, 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 many years. It's just at the moment, they don't seem to last that long, certainly not on the US markets. So now you know. Observationally, our back of the envelope research is saying, you know what? It probably isn't in. Now, no one can, that's the best we can say. Now, this is one of the hard parts that you all need to come to terms with. The best we can say, despite all that, we can't say a hard, no, it's not. The best we can say is probably not. And as soon as you can come to terms with that, because with new information, we've got the luxury of being able to change our mind. Don't be married to it, because that's what got me spanked after during the corrective move that we now know as a V-shaped bottom. Use that 200-period moving average. For the moment, you know, the bottom's probably not in, but if it transitioned above the 200, it broke that previously identified consolidation. You know what? Maybe I can change my mind. Again, we didn't see a footprint where that happened on a regular basis, but we've got to keep that as a possibility in our back pockets. So the flip side to all of this is always have always be prepared to change your mind, and always think about, well, what if that didn't happen? What if we didn't see? What if we did see a turnaround in price? What would that look like? Well, price needs to go above that consolidation. That would take it above the 200-period moving average. At that point, whatever happens, despite the evidence of our own eyes that we've identified, we've got to flip back to being bullish. We've got to. A new pattern may be emerging that we've never previously observed before. Again, I'm just throwing out the possibility. But if we look at price in relation to the tools that we're using, and again, just to restate, we're looking at the 200-period moving average, the 50-period moving average, and the 20-period moving average. When they're stacked on top of each other, you've got to be bullish. When the 20 and the 50 is flipping and a flopping, you've got to say ranging. When they're stacked the other way, you've got to say bearish. Expansion, contraction, direction change. That's how it goes. Think about like a concertina. Sometimes the metaphor that's used is tide in, tide out. When the tide's going in and out, it's creating these trends, trending opportunities. All right. With that said, let's do it. Let's look at the. Let's look at some stocks. Oh, I did forget. So, just for the new people, I did forget to mention the way that I look for trades. So promised you that we were going to look for, at the beginning of the session, we're going to look for a buyable dip in the context of a trend, or in the case of the S&P, which is what we're looking at right now, a sellable rally in the context of a trend. Just because price is dipping or rallying doesn't mean that we have an opportunity to buy a dip or sell a rally. We need to put it in context of trend. We know what the base trend is. If it's above or below the 200-period moving average, that's going to give me my directional bias. Ideally, I like to see then use the 50 and the 200-period moving average. My apologies, the 20 and the 50 moving average. And if they're stacked on top of each other like they are here, then that's giving me my trending indication. So then what I'm going to do is I'm going to look for where price is in relation to the moving averages. And as I usually say at this point, there's nothing magical about the moving averages. It's just allowing us a frame of reference to say, where is price in relation to the moving averages? So just to keep it simple for the moment, I'm just going to focus on the 20 and the 50-period moving average. And I'm going to say when price comes back to the 50, it could be the 20, but again, just for simplicity, when it comes back to the 50, having been above, when it comes back between, I'm going to consider that a buyable dip. Woo! That means that I'm not trying to buy every dip. I'm just looking for what I consider to be a buyable dip. So not every down move is tradable. Not every dip that is bought makes money. But we get this opportunity to find multiple trading opportunities in the context of a trend. I've got a little algorithm that will run the numbers for me. So if I just did what I've just described, look for a buyable dip when it comes between the 200 and the 50, I will consider that a buyable dip. When it goes away and back above, then I will call that my trend. That's the bit I want to profit from. So if I just did that over the last 20 years, I can put at the click of a button, say, if I just did that and nothing but that and only that, a buyable dip and the opposite, a sellable rally, then I will have a positive expectancy. So this is the algorithm that I've just described to you, nothing more, nothing less, would not take it into account Fed, interest rates, war, famine, whatever bullshit's going on in the world, weird shits, COVID. None of that's considered. Just those rules. Buy the dip, sell the rally. As I've just described, then I've got a positive expectancy. I know that over multiple occurrences that I should have a steady incline on my equity curve. And this is non-compounded. So I'm not like fudging the numbers with compounding and the eighth wonder of the world. And it's just like $1,000 in and whatever you get out of that every time. So it's a steady equity. Now, not all trades make money. So I'm just going to highlight the rules. When it goes above, go long. When it comes back below, close it or get stopped out. So I'm just highlighting the ones that, according to the algo, you've got the little works it all out, plots it all on the chart for you. Some of them make money, some of them lose money. On average, and this is what I mean, on average, over multiple occurrences, we want to make money. just like any other business in the world. The business of trading is no different. If we had a shop on the high streets, you're going to have some customers that buy little trinkets. Some customers buy 3 or 4 things. Some customers buy one of everything in any color. Some customers come back for a refund. Some arseholes rob stuff from you. On average, you're still making money, despite all the trials and tribulations that go with owning a business on the high streets, our famous shoe shop on the high street that Phil likes to talk about from time to time. On average, it makes money. Theoretically, in our hypothetical, it's a good business example. And the stock market business is no different. On average, over multiple instances, I should make money. And this is what a positive expectancy strategy looks like, based purely on data with no subjectivity. Now you know the secrets. Price is below the 200. We've transitioned for 3 to 6 months. We've got to be bearish based on our observation is saying, you know what, we're probably in a bear market. The average prices, the 200, prices below the 200, prices below the 50. It's just back above the 20. This is a sellable rally in the context of a downtrend. Notice the way I'm saying this. It's a statement, a buyable dip, a sellable rally. Now, I've got a sellable rally. I'm not yet selling it. Don't mistake what I'm saying. Just because I've got a rally in a downtrend doesn't mean I'm automatically selling. As we said, I want to see price go back below the 20 or up to the 50 and then back below the 50. That's what I'm looking for. It looks like it's going to make it to the 50. Great. I can get a better price to sell the rally. Now, this rally is going to be good for individual stocks because the bullish side of my portfolio theoretically should be profiting from this rally, despite the markets being in a downtrend. This is the S&P. The market is in an early stage downtrend. Now, there's still bullish trading opportunities. And that bullish side of my portfolio should be profiting as the rising tide lifts all the bullish ships. Be very careful how you say that, Phil. When the sell-off happens, then that sinking tide will lower all the bearish ships. Is that the right way of metaphoring it? It is now. You get the idea. It paints a picture, probably not the right one, but you get the idea. So let's go and look for trading opportunities. So I like to trade individual stocks. I like to trade a portfolio style approach. I like to start my research of what I should be trading based on a small list of proven winners. So the first part of how I apply what I've just described to you is I'm only looking at my, for example, top 25. I've actually got a top 50 and a top 100 that I do trade, but just for simplicity, I usually start everyone off on at least the top 25 stocks. That's it. These are what I consider to be proven winners. How do I know that? Well, I can plug these stocks into the algo that I just showed you and say, is it worth my time trading this stock? If yes, if steady equity curve, add it into the mixing pot. A quick example of what I will never trade is Pepsi. Pepsi's a great company. Based on the last 12 months, visually, it looks like that system would have worked. But does it work long term? Actually, no. There's the zero line. There's the making money, losing money line. Making money, losing money. Long term, over 20 years, 22 years, in fact, over the last 22 years, this has been on average a losing prospect. So I'm never going to trade Pepsi. Now, I could trade Pepsi. I can trade Pepsi. I have traded Pepsi. But it requires discretion. It requires a little something extra. It requires screen time. And as I said at the beginning of our time together today, I don't want to spend time flicking through chart after chart like a mindless zombie, trying to figure it out and go, where's the trade? This is a where's the trade stock. Which one's going to work? I don't know which one's going to, because some of them work. Some of them make money. I don't know which one. I don't ever want to go, where's the trade? I want to go, there's the trade. That's the experience that I want. So these are all stocks on the left here. These are all Apple, for example. Unsurprisingly, Apple's on the list. I don't ever want to go through the experience of where's the trade. I want to go, there is the trade. So Apple is a there's the trade stock. I need to take every trade. I don't know which one's going to work. I don't know which one's going to make money. I'm not smarter than anyone else. I don't have a crystal ball. All I know that on average, Apple over multiple instances makes money. Cool. I'm going to include that in my list. It's a steady equity curve. Cool. That's what I mean by that. So what I can do is that system that I just described to you. One of the things that makes it even faster is I can take that proven list of winning stocks and I can rank and sort them. The first thing I'm going to do is which stocks are bullish and which stocks are bearish. So at the click of a button, what's the trend? Is price above or below the moving averages? Right, they're all my bullish stocks. They're all my bearish stocks. And what you'll notice is they're about, out of those 25 stocks, they're about even. They're about even. So one of the benefits of a portfolio style approach is that you're going to naturally have a number of bullish stocks and a number of bearish stocks. And if you trade the bullish stocks when you're supposed to be trading them and trade the bearish stocks when you're supposed to be trading them, then you will never be stressing over a market crash. In fact, if you think about it, you'll be hoping for a crash because that's when you can make the most money in the shortest space of time because you're already positioned to the bear side because they're already trending down. They're already going down. Ring Central, great RNG. Ring Central, come on. Trade station a little bit slow. It's in a long-term downtrend. Average prices crossed over, prices below the 200. Sell the rally in a downtrend. Multiple times to sell the rally in a downtrend all the way through 2021 in a time where the market was doing the exact opposite. So I don't believe in the stock market is only going up, therefore I will only be bullish. Clearly, it's absolute nonsense. So the way that a portfolio style approach works is to trade both sides of the markets, bulls and bears. And what should happen, it doesn't always happen this way, but what should happen most of the time is that when, even if, let me go back to the S&P. So what should happen is when the stock, so we're in a bearish move right now. So we're in a bearish move right now. So when the bullish move, in this case, the rally in a downtrend happens, the bullish side of the ledger is going to improve. And when the sell-off happens, which we've just seen over the last week or so, then the bearish side of the ledger is going to profit because you've sold the rally in a downtrend. This upward movement on the market creates the rally in a downtrend. Is this making sense, people? Let me know let me know if that was an aha for anyone. Did that land? I felt that was a stick a pin in it moment. Just put a line under it. Does that make sense? Even though the market is bearish, this is a rally in a downtrend. This rally in a downtrend on bunny fingers time, the market is creating the rally in a downtrend on the bearish stocks, but it's also creating the rallies, in an uptrend in the already bullish stocks. So the sell-offs create the dips, the rallies create the rallies. Simple little concept. And this is why I can not stress over what the market is doing. I've got a number of bullish positions, a number of bearish positions, or a number of bearish opportunities. So I can see that there's a natural inclination to have what essentially could be a balanced portfolio, balanced from a directional viewpoint. So all of these are the bullish stocks. And now I want to know, are they above or below the 200 period moving average? So that's the column that I'm just highlighting now. Are any of these or all of these above or below the 200 period moving average? So here's two that are in a bullish posture, meaning the 50s crossed over the 200, yet price is below the 200 period moving average. That's what these are. So there's a little bit of conflict in direction. If I just go to Apple, you'll see what I mean. I typically want the average prices to be crossed bullish. So they're crossed, now the 20 and the 50 are almost crossing to a bearish posture. Price is below the 200 already. So we've got a little bit of conflict in direction, We want to see price above the 200 and all the averages stacked on top of each other. That's going to give us that trending experience that we're looking for. So these two here are not meeting that trending requirements. So I'm just going to ignore them. I'm just going to put them in a separate little position and not worry about them. All the bearish stocks are below the 200, which is great. So I know where price is in relation to the moving averages. The next thing I can do is rank and sort all the stocks relative to the 50-period moving average on both the bullish side and the bearish side. So what I've now done is said, okay, well, these stocks here are in a bullish posture, but they're also dipping in relation to the 50-period moving average, that column there, dipping in relation to the 50-period moving average. So this is the Bible dip that I just described to you. The Bible dip is not an automatic buy, as we know, but it means that, you know what? These are the four stocks I'm going to, these are the 4 or 5 stocks I'm going to look at. These are the ones that make the most sense because this is my trading opportunity. And conversely, you've got a rally in a downtrend. So I've got 1, 2, 3, 4. I've got 5, maybe, without looking at the charts. Again, all this is without looking at the charts. We're only looking at the charts so you can see with a little bit of example. So I'm not looking at the charts. I ignore the heavy lift on the left. These are the 5 bullish stocks that make the most sense to look at right now. There may be a trading opportunity right now, but I've not yet looked at them. And similarly, on the bearish side, I've got 3 stocks that are rallying in a downtrend. So I can quite literally plug into a quite quick balanced portfolio if they all met the entry requirements to put 5 bullish trades on, 3 bearish trades on. That's okay. There's going to be a little bit of imbalance from time to time. But you know what? If the market crashed, those bearish trades would far outweigh the losses that would be appreciated on the 5 bulls. So we have this interesting way to plug into a quick portfolio. Even if today's day one, you can rank and sort the stocks relative to their averages. I'm just sorting. So these are all the stocks that are bearing, as I like to say, they're bearish and in a downtrend. And these are all the stocks that are bullish and in an uptrend, and they're bulling. They're all stacked above the moving averages. So that's what we have here. So we can also start to do things like, well, if I'm already in trades, you know, if these are in a bullish posture and are starting to accelerate away from our moving averages, again, the chart's intentionally blank. So if price is accelerating away from all the moving averages, you're going to have all these boxes blue, blue, blue. That's what we're saying here. Price is above all the averages. So I get to quality control. You know, am I in COP? Yes. Am I in that CVX? Am I in SQM? Actually, no. I miss SQM. Just one of those things. I only recently added it to my top 25. That's my excuse, and I'm sticking to it. Bearish trades, BBWI. So these 4 here, you know, price needs to be below all 3 moving averages. So is it below all 3 moving averages? So at quality control time, am I in all the bearish opportunities? Where's my draw widget? So am I in BBWI? Am I in ISG? Am I in Ring Central? Am I in SLG? Am I in SIG? Am I in all of those? Yes, great. I'm in all the potential. So I'm consistently trading the strategy that we've proven works on a group of proven winners. So I should be able to emulate the back-tested performance on each of these opportunities. And I can, and if I need something to trade right now, I can zero in on these stocks right here. I can quality control myself to say, okay, these are the ones that are starting to move favorably. Am I in them on the bullish side and the bearish side? And I've got 2 stocks that I'm not going to trade because they're not, there's a little bit of conflict in direction. So when you've got a rule-based structure and you've got some tools that make it easy to do all the heavy lifting, we can quite literally plug into a small group of stocks that are proven winners that make sense to trade on a regular, daily, consistent basis. Now you know the secret, buy the dip in an uptrend. On the chart, you can see my algorithm. That's what these little dotted triangles, it's showing all that historical data. If you'd bought the dip and sold the rallies in the way that I've explained and took every trade with the trade management I like to apply, it's the only thing we've not explained. You can see the latest algo is firing off, or the latest trade assistant is firing off a nice trade entry. So, you know, are you in ConocoPhillips? To be fair, anything in the energy sector is on fire at the moment, if you'll pardon the pun. But we get to find opportunities and zero in on opportunities very, very quickly. So let's just go through. Let's spend the last few minutes just going through some stocks. So CVX, buy the dip in an uptrend. It's just started to move. It's starting to accelerate away and into a new uptrend. Interestingly, you've got that, we observed that 3 to 6 month consolidation in the context of a trend, but price is staying above the 200 and it's starting to break out. I think if we see price firmly push above 180, we can see the next trending move that could last, as we observed, 3, 6, 8, 12 months maybe. What do you think? We've just observed it on the markets. We can go and validate it on the individual stock to see how individual stocks or how long they last. But it's possible we could see something similar. History repeats itself on a regular basis. So it's not complex. It's just knowing what to do. You've all got the knowledge. You've all know how to look at the charts. You know how to have these 3 moving averages. One simple line. No, it's not one secret indicator. It's a moving average. It's a simple moving average. You know, there's nothing complex about what we're doing. We're just looking at how the market behaves in relation to 3 simple moving averages. And I'm going to preempt the next question. Will an exponential moving average work better? Probably. I don't care enough to test it. I'm making money hand over fist regularly. That's all that matters. ABC. Here's our Bible dips, people. Bible dips. ABC is dipping in the context of a trend. It's starting to push back above the 50-period moving average. If I wasn't already in a trade, I would certainly be looking for a trade. It's easy when you know the rules. It's easy when you know the rules. All states is a little bit different because it is technically in a, or has been in a little bit of consolidation. I saw this as a breakout, one of my other 6 money making patterns. But nonetheless, if we just keep with the most mechanical version of the strategy, it's about to stack above all 3 moving averages. It's really difficult not to be bullish when you know the frame of reference that we're using. CLF has been below all 3 moving averages. It's coming back in line. Need it to go back above the 50. Need to be above all 3 moving averages. Is it there yet? No, it's not. Let it go. Disney princess, that trade. Let it go. Oh dear, the coffee's kicked in. LNG. Well, what do we got here? 1 crossing our average price. I think visually we can say it's in a consolidation. It is not really moving. That's like March, April, May, it's lasted about 3 months. The 200-period moving average is 1,000,000 miles away. So this is probably going to be similar to what we just saw with, what was it? Was it ABC, where we've got that consolidation? We'd want to see price go above 150, and that, I think it was CVX, wasn't it? Want to see price go above 150 to see the trend resume. I think it was CVX. We can go and look at the before and after. So we spotted the same pattern, trend, consolidation, 200 to 1,000,000 miles away, prices just going above the range high. Again, if we go back to LNG, you'll see the same footprint, trend, consolidation. Again, this is not really relevant to the actual mechanical strategy rules, but just based on our observation for, is there a market turning point? Well, is it a turning point? It's probably just resting in the context of the trending move. And again, it's in the energy sector, so it's probably going to be bullish in fairness. I'm so bullish it hurts at the moment on LNG, on energy sector. HPQ, look at HPQ. Colin, are you in, my friend? Colin pulled this one out of his, in our little community. Highlighted it there. This is, again, consolidation. 1, 2, 3 crossing the average price. We've got to call this consolidation. You can see the box around it. Several of our members mentioned, I think Colin popped it in first. I don't see you today. Maybe you'll catch this on the replay. You got in somewhere around there, so that's awesome. A little bit of news just to kickstart the move. Basically, all you're doing with a range, trade from the range lows, target the range highs. Surprise, surprise, we're above the 200-period moving average. Is it any wonder that there was a bullish movement? You tell me. You've got to be bullish above the 200. Let's find some sellable rallies. Let's take out Biden. Sellable rallies. Let me just zoom out. So sellable rallies in the context of a downtrend. It's in the sellable rally zone. It needs to go back below the 50-period moving average. Technically, the algo's already in on this one. Again, just an example. They don't always work out. Again, I'm already in, just in the interest of disclosure. but you can plug into the system at any point. If price was to go back below, say, $126, then you're back to being bearish. And for the moment, this is still a rally and a downtrend. I can only say with hindsight that I've mistimed my trade. That's the wonderful thing about what we do. We only know with hindsight what actually happens. Jefferies Financial is bearish. It's a sellable rally. NXPI is a sellable. It's an early stage trend, but it's a sellable rally. AMAT, early stage trend, but it's a sellable rally, unsurprised. AMD, early stage trend, but guess what? It's a sellable rally. BFH, Bush Ferrum, well-established trend. It's a sellable rally. MRVL, Marvell, early stage trend, but it's a sellable rally. SPY, now you know the secrets. Early stage trend. I'm only calling it an early stage trend because the average prices have only recently crossed over. The 50 and the 200 is what I'm referencing. They've only just crossed over. So that's why I'm just saying, it's only happened a few months ago. So it's an early stage trend. Everyone happy with the logic? There is, and there are several bearish stocks to trade, several bullish stocks to trade. None of them are quite today trades, in fairness. I'm not going to rush out. If I had no positions on it open, at all, I'm not going to be rushing out today to put trades on. Doesn't mean that there's nothing to trade. It's just that we've got the sellable rallies and the buyable dips. Now we need to wait for price to turn around and start pushing away from back past their respective average prices to resume an entry opportunity. That's it, folks. That's it. Buy the dip, sell the rally. Doesn't have to be complex what we do. SPY, again, let's just take a look at the data. If you just need some further proof that it works, again, just buying the dips and selling the rallies. This is the algo that does it. There's no thinking involved. Obviously, with a little bit of extra, if you have experience, if you have some charting knowledge, if you have several years of experience to bring to the table, you can layer it on afterwards. I would say find the trade first and layer on a little bit of discretion to enhance the flavor of the trade. At no point am I not going to place the trade, just for reference. So can you use discretion? Sorry, I forgot to read the question. The question was, can you use discretion? You layer it on afterwards is what I would do. I'm going to find the trade first and then layer on. And it might either delay the entry. I mean, you might see that there's some fractal pattern. You've got like a little expanding thing there that you could do. If you recognize those patterns, you might say that, there's resistance. So maybe it doesn't get to the 50. If it gets to the 420, maybe you can sell there. If you want to apply something extra, you can do, but you've already found the sellable rally in a downtrend first. You may use a little bit of extra chart reading skills should you choose to enhance the flavor of the trade. It might speed up or delay the trade entry as far as I'm concerned, but I'm never not going to place the trade based on discretion. We've got the data to prove place the trade. I'm going to put the trade on, but we can, if you want to tinker with it. It's not mission critical, as I keep saying. I try not to do it at all these days. Just because, again, the data's right there. I've got no reason to apply discretion to my trading. I'm just trying to emulate the results, if not outperform the performance there. But yes, it is possible to add discretion should you choose to. It's not essential to the process. Right, where's my slide deck? There we go. So that was production line trading. We pretty much just focused on one teeny tiny element of the process, which is my number one money-making pattern, which is buy the dip in the context of a trend. And that is essentially all we were doing and all we were looking at. We also looked at the opposite, which was sell the rally in the context of a downtrend. And that's it. There's other elements to what we do was a part of the whole process. There's mindset, there's growing and measuring our process, because maybe we're applying the process incorrectly. There's lots of learning involved. There's a little bit more to trading. For anyone who's done it for any length of time, there's a little bit more to trading than actually just knowing the rules of the system. But knowing the rules of the system means that you'll always know what to do, when to do, and why you're doing it. Your entries, your exits, your stops and targets. And then you just need to go and actually do it. And for a lot of people, that's the hard part. So if you do need some extra assistance with making it work in a very short space of time in the smartest possible way, you can work with me. I have a group accelerator. I also do occasional one-on-one mentorship. It is the fastest way to get where you're going in the shortest possible time with a system that actually works. Unsurprisingly, there's a lot of systems out there that are just all fluff and nonsense. Hopefully today I've demonstrated that it does work. And if you'd like some assistance with it, then get in touch. And that's as hard a pitch as you're ever going to hear from me. So let's, let's land the plane, folks. I just want to, as always, thank you for your time and attention. I don't take it for granted that we could all be doing something else with our time today. I want to just express my heartfelt thanks for deciding to spend some of your time with me today. But what was your biggest takeaway? Wrong one. What was your biggest takeaway today? Oh, I've lost my slide. There we go. What was your biggest takeaway? Anything interesting? A pleasure, Rodrigo, a pleasure. The double bottoms were kind of wide, yeah. Wide load ahead. It's quite an eye-opener, isn't it? I mean, the 2020 crash and subsequent correction, the V-shaped recovery, is the exception to the rule. It caught so many people, like many funds went bust because of it. It didn't beggar me just with the way that I approached my account management, but it did back me into a corner for a short space of time. So yeah, it's quite an opener, but you can start to see why I was so adamant it's going to retest the lows, and why I was very arrogantly calling a double bottom. History tells us it happens on such a regular basis. It was expected. So I'm really pleased. Thank you for all your feedback. Thank you, Perry. Thank you, Rodrigo. Randall, as always, you're not my friend. I can't help it. It's just part of it now. Awesome, Rajesh. Yeah, good observations on the rally, 3 to 6 month consolidations. Yeah, it's an interesting observation. Again, it's not necessarily mission critical to the strategy as we observed, but it will help allay any fears. Is the bottom in? Well, probably not. We're probably going to see some more downward movements. Now, we know at what point we're going to change our viewpoints because we've got a structure and a framework that we went through to say, when this event happens, I kind of got to be bullish regardless of whatever I see. But I'm expecting a rally and a downtrend. I'm expecting when the bottom is in, it's probably going to last 3 to 6 months before a subsequent turning point. But yeah, we get that very easy observation to make if we just open our eyes and look and go and look at what history tells us. So I'm really glad that was everyone's takeaway. Thank you very much. Oh, thank you for your, thank you, Tom. So let's do it. Let's dock the boat, folks. Let's furl the sails. Let's land the plane. Let's charge the Tesla. End scene, roll the credits and fade to black. Thank you all once again for deciding to spend some time with me today. Make sure that you enjoy yourselves. Make sure that ice cream is involved somewhere in the next few days. Have a wonderful weekend, and I'll see you all next time.